Okay, let's step into the dark server rooms and glowing data centers of Silicon Valley. In this explainer, we're diving deep into the financial engine of the most valuable artificial intelligence company in history, OpenAI. And we're going to unpack a mysterious, high-stakes situation that critics are calling an intricate, completely circular financing loop. It's a story of extraordinary technological promise, massive capital, and a web of deals that could literally reshape global markets.
We have to start with a number that is just almost incomprehensible. $850 billion. That is the implied valuation OpenAI was reportedly approaching in some 2026 projections. I mean, just let the sheer scale of that sink in for a second. We're talking about a number that rivals the entire GDP of several countries. But when a private company's valuation skyrockets to this level seemingly overnight, we absolutely have to ask a very profound question. What exactly is holding that number up in the dark?
So is Silicon Valley actually building the future, or are they just borrowing against it? Think about this. What if billions of dollars are flowing into one single company, only to flow straight back out to the exact same cloud providers and chip manufacturers that invested the money in the first place? It's a fascinating and, honestly, a slightly unsettling concept. To figure out if this is a revolutionary build-out or just a spectacular bubble waiting to pop, we really need to look at how we actually got here.
Let's trace the timeline because, OpenAI didn't start out as this multi-hundred-billion-dollar corporate juggernaut. Back in 2015, they launched as a modest non-profit research organization. The mission was super pure: make sure artificial general intelligence benefits all of humanity. They had up to $1 billion pledged. The reports suggest only a fraction of that, around $133 million, actually came through by 2021. But then came a crucial pivot. In 2019, they shifted to a capped profit structure. Suddenly, investors could get returns, theoretically capped at 100 times their initial investment. That very same year, Microsoft dropped $1 billion in, which they followed up with a massive $10 billion announcement in 2023. And Microsoft didn't just become an investor, they became the company's primary cloud provider.
After that restructuring, the upward trajectory of their paper valuation is just dizzying. Early 2023, a $29 billion valuation. Jumped to October 2024, roughly $157 billion right after a $6.6 billion funding round. And then you get those unbelievable implied projections, pushing toward $852 billion in 26, backed by absolute heavyweights like SoftBank, Amazon, and Nvidia.
And this is where things get really interesting, because there is a striking dissonance here. Yes, the reported revenue growth is explosive. We're talking about jumping from roughly $200 million in 2022 to a projected $3.7 billion in 2024, and forecasting an incredible $11.6 to $13.1 billion by 2025 or 2026. That is undeniably rapid growth. But despite all that revenue, the company is reportedly projecting operating losses between $5 and $8 billion in 2025. So the billion-dollar question is, how can a company with billions in revenue growing this incredibly fast still need enormous, continuous injections of new capital? Well, the answer lies in the sheer, unimaginable cost of computing power.
Let this next number really sit with you for a moment. $250 billion. That represents OpenAI's reported commitment to purchase an additional $250 billion of Microsoft Azure cloud services over multiple years. When you compare that to their reported annual revenue of around $13 billion, you realize this is a massive forward obligation. Now, to be clear, they didn't hand over $250 billion in cash today, but it is a heavy contractual weight placed squarely on the company's future.
Financial documents outline that this kind of forward obligation isn't just a standard run-of-the-mill utility bill. In fact, critics describe it as a potential debt trap. It's not traditional bank debt necessarily. It's more like a dense, tangled network of long-term cloud contracts, massive hardware purchases, and huge infrastructure commitments. If their growth continues flawlessly, then hey, this capacity is exactly what they need to serve millions of new users. But if that growth ever slows down, these agreements could become incredibly burdensome, locking up the company's choices for years to come.
And this intricate structure creates what critics allege is a totally circular ecosystem. It goes like this. Step 1. Investors, who just so happen to be tech infrastructure giants, provide capital to OpenAI. Step 2. OpenAI takes that very capital and uses it to buy computing power and chips from those exact same investor providers. Step 3. The providers log those purchases as massive revenue, boosting their own financial metrics. Step 4. Because OpenAI is using all this compute to build better models, their own valuations rise, which makes it easier to raise even more capital, and the loop repeats. Critics argue this setup blurs the line between a genuine investment and simply vendor financing, artificially inflating the growth narrative for literally everyone involved.
Plus, this tangled web extends way beyond just Microsoft. There's a reported 5-year agreement with CoreWeave valued at around $12.9 billion, which reportedly even included an equity component, making OpenAI both a customer and a shareholder at the same time. Then you have proposed massive deployments and investments with Nvidia, agreements with AMD involving literal gigawatts of chips and equity options tied to performance. Oracle is reportedly connected to a multi-year data center deal potentially worth hundreds of billions, linked to the massive Stargate initiative. It's a vast, somewhat opaque ecosystem of hardware giants, all seemingly feeding into and benefiting from the exact same financial loop.
Now, we need to be extremely careful and precise here. It is absolutely crucial to separate the explosive legal term Ponzi scheme from the metaphorical critique that skeptical analysts are throwing around. A classic legal Ponzi scheme involves deception, straight-up fraud, and a complete absence of a productive business. There is zero public evidence that OpenAI is operating a legal Ponzi scheme. They build real products, millions of people use ChatGPT every single day, and huge businesses integrate their models globally. But commentators are using the term metaphorically because the business model resembles a fragile, self-reinforcing confidence loop, one that is highly dependent on continued, massive capital injections just to survive its staggering infrastructure costs.
So instead of a fraud, cautious critics argue we are witnessing what they call synthetic growth. And this is a fascinating lens to view things through. It's a highly capital-intensive system where paper valuations and reciprocal contracts just keep growing at astronomical rates, even while the central company continues to report enormous operating losses. As long as confidence remains intact, the cycle hums along beautifully. But you have to remember, it relies heavily on the expectation of future dominance, rather than any present cash generation.
Of course, we have to balance this skeptical view with the bull case. Supporters argue that today's massive losses are simply the cost of building an entirely new technological platform. Think back to the early internet or massive telecommunications companies. They spent enormous amounts of money laying cable and building networks long before they became wildly profitable. If custom chips lower costs and AI becomes embedded globally in literally everything we do, OpenAI could easily transition from a compute-heavy utility into a highly profitable, high-margin tech platform. They're even projecting hundreds of billions of revenue by 2030. But on the flip side, the warning signs are equally real. Funding fatigue, the risk of overbuilt data centers, stranded GPU capacity, serious regulatory hurdles, and fierce, relentless competition. If all these pressures hit at once, it could trigger a systemic, painful deleveraging cycle across the entire tech sector.
Ultimately, we are left with a lingering, unresolved question. OpenAI undeniably has real products, real revenue, and they have achieved absolute technological breakthroughs. But the company is surrounded by extraordinary risk. The deeper question we have to ask is this: can the future profits implied by an $850 billion valuation eventually justify the vast, incredibly expensive infrastructure being built today? Because right now, the AI race is powered by more than just brilliant algorithms. It is heavily powered by confidence. And in financial markets, while confidence can build empires, its sudden disappearance can very quickly reveal exactly how much of that empire was built purely on promises.